15 seconds and we'll get cracking. Okay, good afternoon. My name is Carl van Randwyk and I'm the Chief Growth Officer at Themis. I'm delighted to be moderating today's session, which is being organized in partnership with Fiserv. The wealth and asset management sectors have traditionally been deemed relatively low risk in terms of financial crime exposure. However, the value of global assets under management is growing rapidly and criminals are looking to exploit new channels, which means that investment managers face both new threats and increased regulatory scrutiny. Comprehensive financial crime risk management and due diligence are more important for the industry than ever before. Themis and Fiserv have partnered to research red flags, challenges, motivations, and expectations when it comes to financial crime in the investment management industry. As part of our research, we surveyed a range of investment managers to gauge their views about the current threat landscape. Nearly 80% of those surveyed said their organization had been exposed to financial crime risk over the past 12 months, highlighting the importance of our discussion here today. To learn more, please consult our white paper, which summarizes our findings and which we will be sharing with all those who have registered for this webinar. To bring our research to life, we wanted to explore some of its key themes with a panel of industry experts to hear their detailed insight leading financial crime teams in investment management firms. I'm honored to introduce our panel of distinguished guests today. Firstly, Katarina Cook. Katarina is the head of financial crime and money laundering officer at Brewin, Dolphin. She has a broad range of experience from various financial crime prevention related roles in banking and wealth management. Katarina has been a board member for ACAMS Netherlands chapter and is now chair for the ACAMS UK chapter. Excited to support ACAMS and industry practitioners to stay informed of regulatory change, trends, and best practices. Steve Heinemann. Steve is responsible for managing financial crime and IT risk across the global Aviva Investors business. This includes strategy, policy, the financial crime risk management framework, cybercrime, training, prevention investigation, and compliance monitoring. That's quite a lot, Steve. And Steve has 14 years experience managing investigations and financial crime prevention activity. He chairs the Investment Association Financial Crime Panel and is a member of the JMLSG editorial panel. Prior to joining Aviva Investors, Steve was head of financial crime at the Phoenix Group and Bank of Ireland, and after having trained as an internal auditor with Deloitte. Andrew Davies. In his role as Vice President, Global Market Strategy, Financial Crime Risk Management, Andrew works with Fiserv customers around the world to design and deploy effective financial crime risk management solutions. He is also responsible for seeking new markets and applications for Fiserv's financial crime detection and prevention solutions. He previously worked for Logica and Nomura in London prior to moving to the US, where he is currently based. He is a certified anti-money laundering specialist who has presented at numerous industry events and contributed to articles and publications such as the American Banker Credit Union Journal, Finextra.com, and Payments.com. That's quite a panel we have in front of us, and a lot of experience and insight to be shared with us. Before we start, I'd like to start with a poll. And if everybody could take a look at this poll and choose which of the following financial crime threats is the investment management industry most exposed to. And we'll take a few minutes to see what everybody votes and provide us feedback on, and we should be getting the results through pretty soon. Interestingly, I have the results of a similar poll from our white paper and the research that we did for it together with Fiserv. So we'll see if there's any difference between our audience's views and what our research found. Interesting. Well, the top scorer is money laundering, followed by fraud and cybercrime. That's interesting because from our research that we did for our white paper, the majority thought that fraud and cybercrime were the biggest risks at 63 and 57% respectively, followed by money laundering. So there is an interesting difference here between our audience and the research that we undertook, but there are still some similarities. Katarina, if I could turn to you first, um, as I'd like to gauge your views on the most pressing financial crime risks facing the investment management industry at the moment. Would you agree with our poll results? And would you have assessed threat levels any differently before the onset of COVID-19, when the majority of financial services personnel started working from home?
Thank you. Yes, I think we did expect fraud to top it, perhaps with cybercrime and then AML, but in all honesty, you can't disagree with the poll because it represents the people on this call. So, they're all strong contenders. And I do think the way you look at it as well, your fraud cash becomes money laundering, right? So it's all about that predicate offense underneath as well. I don't think they're surprising figures. I would agree with them. And I do think there is a change. Perhaps there isn't so much a change in which one of these would top the poll a year and a half ago and now. Maybe it would still have been money laundering and fraud and cybercrime back then. I think it's all about the change in how that poses the risk to the organization and what it is that you need to look at differently. When COVID first hit, there was this need to, in particular, I would say, focus on fraud, focus on the fact that people suddenly started working from home and more vulnerable, a lot of people with kids at home, and it just completely throws everything up in the air, and that's the ample opportunity, right, to commit fraud. And fraud also comes with all these different aspects. You have a fraud against your firm, you have a fraud against clients. So you have a lot of victims in this area as well that you need to worry about. And I guess the risk is slightly different to an organization, whether you're worried about the firm or the underlying clients. We certainly saw an increase in impersonation fraud, and that targeted our firm particularly. I think it was in April, May last year that there was an impersonation fraud going using our firm name, but also individuals' names managed to take money from a lot of people. We probably only know about a very few of those that were targeted. We've also seen an increase in investment fraud against clients. We do have, as a wealth manager, perhaps a larger proportion of elderly and more vulnerable clients. And it's not that we get directly involved because we wouldn't pay out to the fraudster's account directly, we would pay into their bank account. It's more about observations in their behavior, calling up stressed, wanting money quickly. It's not something that is normal for us. So there's been, I think, a big change in what you need to watch out for. But overall, you're still looking for the red flags that you used to look for. I also would pick up on what you said, Carol, in the beginning, that, the money, there's more money around. I read this really interesting article recently in FT by Rashir Sharma, The Billionaire Boom and How the Super Rich Soaked Up COVID Cash. That's worth a thought. It doesn't mean it's all dirty, but there's an estimate that central banks injected 9 trillion into economies. And where has that all gone? And also the recent NCA strategic risk assessment for 2021 that talks about 12 billion criminal cash generated in the UK every year. We're not really a low risk jurisdiction, are we? So there is a lot of things to consider.
Katarina, thank you. A lot of food for thought there, and particularly the comment you made about fraud having lots of victims. It's not a victimless crime, and people do suffer as a result, and mentally, emotionally, and also in their pockets. Thank you. Steve, turning to you now. How does the current threat landscape look from your perspective at Aviva Investors? Evidently, risks vary depending on an investment management firm's exact profile, customer base, and size. So I'd be interested to hear your views.
Sure, thank you for that. I think Katarina has touched on the biggest point for most asset managers at the moment. There has been a big fraud increase, especially around brand protection fraud. So people being defrauded, thinking they're investing with a big brand or a well-known brand. Some really nasty examples of this over the last year, especially around fake price comparison websites. So people who have spare cash because they'd ended up in lockdown when they wanted to spend it on a house or on a holiday, going onto Google, looking for a price comparison website, seeing lots of good offers with lots of opportunities, but every single one is fraudulent. And they go into one of those, and it's very different. They're not expecting to hear anything from until a quarter in or 6 months in, and when they contact us, the money is gone. That's been a huge increase. There has been some a fair bit of government response to that. So the SEA have been doing a communications campaign. If you go onto the Aviva or Aviva Investors website, you'll see that front and centre. We've been doing a lot around communication in this area. Phishing and email fraud has increased massively during lockdown across all the different types, but investment fraud as well. And it is definitely something to be aware of. But it's not the only financial crime risk that we face. I think there's sometimes a feeling that asset management don't come into contact with financial crime so much, and I think that the risks are there, they're just different. On the AML side, obviously we have to be careful of customers bringing large amounts of money to us, and I guess that's the thing that really marks out asset management is the size of investment. And we do get investors globally and investment funds globally, and we need to make sure we've understood those, and that's the normal client due diligence rules. But we're also investing in things. So regulated stock exchanges, you would normally expect to be fine, but obviously we had the mirror trade incident with Deutsche Bank a couple of years ago, so you do need to be careful about who you're using, who you're allowing to do what on your service. But it's the economic outcome outlook, which is the real kicker. You know, trying to get that regular kind of 7% return on bonds and normal equities to pay back into pensions and into saving schemes is just going to become more and more and more difficult. That's not straightforward. So the only way firms can do that is to invest in other and more interesting things. As soon as you're in the world of infrastructure, of real assets, of real estate, of commercial mortgages, there's lots of great opportunities there, but much, much more complicated. We do more CDD around those things than we do around customers. And it's not traditionally the real estate, real assets world has not been as tough as it might have been on those kind of processes, and we really need to drive that as investment managers. The other big one is bribery and corruption. We are normally selling our products globally. That's the wonderful thing about global investment funds. So we can have people or third parties, distributors all over the world promoting what we've got, and that's a straightforward risk that they may look for some incentivization which is inappropriate. Usually for that means dealing with the global distributors, the global banks about what controls and things they have in place, but standards are different in different countries. People don't want to be held to the same level of control as required under the UK Bribery Act. So that's always a challenge.
Steve, thank you very much. I've just been jotting down a lot of your points, and it is a real challenge when you are a global organization such as Aviva Investors to rely on the controls of your distributors. And I'm sure that's a conversation that we can have separately offline, but it is one that the investment management industry does need to think about and address. Andrew, turning to you now, our research makes clear that investment management firms have quite different inherent vulnerabilities and financial crime risk management priorities compared to banks. You work with a diverse range of subsectors within the financial services industry. Would you be able to comment on some of these differences?
Yeah, absolutely. Thanks, Carl. One of the things I'd like to sort of mention, I'm sort of quite inspired by the comments from Steve and Katarina already. And actually, I was sort of like waiting to sort of, but both of them heavily invested like Themis in the industry in doing the right thing. And, I know that we talk about, protecting our organizations from fraud and different types of financial crime, but there's this sort of moral imperative that we're all here in support of. According to the, and this is a consequence of COVID, according to the, there was a human trafficking report from the UN in late 2020 that talked about, for the first time in decades, the number of people globally driven into extreme poverty has increased. First time in decades. And of course, financial crime, fraud, synthetic identity fraud is counter-cyclical with the economy. So as there's sort of more economic pressure, you see more types of financial crime. And we're living in a world where across all of those industries that you mentioned, there's between 2 to 5% of global GDP is laundered through the financial system. And as an industry, how much of that do we detect? It's estimated by the UN to be 0.1 to 0.2% of the amount of money that's laundered. Really, that's not good enough. So collaboration with, working with ACAMS and education, as Katarina sort of provides that sort of guidance to people in the industry, and then Steve in similar roles. That sort of collaboration, that sharing, and I'm going to talk about it from a technology perspective a little bit later, but that is so important, collaborating across our organizations in the industry. In terms of what differences we see, it's quite interesting. So Steve mentioned something that is very different in the sort of securities industry broadly, and that is the due diligence you need to do. So if you're doing KYC on some retail banking customer, then that's pretty straightforward. That's sort of it's not routine, and some people still don't get it right, but it's much simpler than if you're establishing some sort of institutional relationship, or you're investing in some infrastructure investment, and you need to do due diligence on the managers of the infrastructure fund. It's much more complicated. I think that's one of the differences. I hadn't really sort of like called that out initially, but I think that's a good point from Steve. The other things that I'd sort of like sort of really identified what we see is, if you're going into a financial institution, a large bank, they've got a lot of volume of data. They've got a lot of transactions to monitor, to uncover anomalies. They've got a lot of investigations that they've done previously, and you can derive intelligence from that. If you're in certain types of investment products, you've not got that. It's not like I'm using my ATM card. Not that I use that anymore, actually. I never use it now. I don't carry cash, apparently. But you have just a higher volume of transactions. So I think we need to be more intelligent in identifying the red flags with a smaller set of data. And we all live in a world where we're overwhelmed by data all the time. So I think the lack of, we need to intelligently use data appropriately. So one of the projects we've done recently is with a retail brokerage firm here in the United States. And basically we've looked at, they've got a lot of transactional data, but not as much as a bank would have. But then they've got a lot of intelligence built into the outcome of their investigations, and we feed that into the detection part of managing financial crime. The other thing I'd say is generally, and I'm sure this doesn't apply to the folks on the call here, generally technology usage is less advanced in some of the securities firms for managing financial crime. So they're probably the differences that I managed to ramble on probably for more than my time.
Steve, Andrew, thank you very much. Very enlightening, and particularly the difference between banking and investment management in terms of the volume. But I'm sure, as Steve mentioned earlier, the size of the transactions might also be different. And when you're looking at the different scale of the investment managers, from the global to the more wealth managers, the sizes are different. But it's about using the intelligence of the patterns and to see to what extent they are anomalies to what you would normally see. Katarina, coming back to you again, it'd be great to hear your views as well, as I know you have come to the investment management industry from a banking background. You spoke to us previously about the differing challenges facing heads of financial crime in these two sectors, including around payment filtering and monitoring. Be fascinated to learn more about your specific experiences tackling financial crime issues in both environments.
Yeah, I think it's been an interesting journey. I really had to change focus from indeed volume and money movement to origin of the money and KYC. You know, if you take a regular monitoring system for transaction monitoring, if you have a client who pays in 1 million per year, well, how are you going to tune that system? It's a bit tricky. That would kind of spike alerts every time. So I think it took me a little while to get used to that. You know, I could actually get rid of the panic around payment filtering and things like that, because there's very little going in and out in comparison. And also, you know, here is where I think the broad spread of types of investment managers out there will have a very different approach. So if you are the type of wealth manager that we are, with, you know, very sort of, you know, you reduce your inherent risk by saying, oh, you can only pay in from your own account and out to your own account. You know, you get rid of a lot of the headaches around third-party payments. But nevertheless, you still need to come up with a way of monitoring that. In terms of, for example, investment fraud, could be quite interesting to see if suddenly a client starts extracting money. Then we're not worried about where it's coming from, we're worried about where it's going. And it tends to be the round amounts of, you know, a few thousand every time perhaps, or something like that. So, and also taking a step back, our monitoring is much more, you know, taking a wider sample, a longer stretch of time that you look at. For example, some of our monitoring is 6 monthly, because you need that kind of breadth to see any change. So I think that was one big change for me. And the other one was around source of wealth. I mean, that's everything for us now. And I always try to say, some monitoring is always good, you know, but and ongoing periodic reviews, absolutely, but it's the onboarding. Like, we have to get it at onboarding. And if we can be a bit of a pain at onboarding and really get down to the true source of wealth, then at least we've, you know, gotten rid of perhaps 70% of the bad ones already at that point. And it's different to onboarding, I think, smaller retail clients or things where you wouldn't expect a lot of money coming in straight away. It is about the behaviors of that client later on. So that's been a really good challenge, something to look at. One of the first things I did implement was an adverse media screening system, because I do think that's a really key one. Very often, like I said, you're not going to catch them on the behavior. They just invest their money like anyone else. Don't forget, criminals are like everyone else. They want a pension, they want money for their kids. I mean, with the laundromat, there was a lot of the recipients back in 2017 were private schools. So, you know, they're all just people. And that's when they come to us, is when they've already laundered the money. So we have quite a challenge in this industry, right, to try and filter that out. So you need a good adverse media system to do that. And also another one that spiked on my radar was market abuse. And of course, that's where we have our automated monitoring, is in the trade systems, so that we can pick up on any potential insider information and deal with that. So those would be my key ones.
Thank you, Katarina. Very insightful. And the thing that I find interesting is that you're also taking in some other aspects of a client, and the fact that you really have to identify them and do your due diligence right at the beginning before they become a client, and really get to know them, because then it's, once they're in the system, it's difficult to do the work afterwards.
And don't forget, it's much harder to get rid of them when you have them as investment clients, right? You don't just take their cash and send it out. You have to de-invest the whole portfolio. And some of that might not be very liquid. So you might be stuck with them for quite some time. So yeah. Yes.
Very true.
Don't let them in.
Steve, now turning to you, on a previous call that we had, you highlight factors that make some investment managers particularly vulnerable to financial crime. The key points that stood out for me were, firstly, around disintermediation and the use of third parties, which you've mentioned previously. And secondly, around the industry's frequent interaction with complex cross-border business structures. It'd be great if you could elaborate on both these aspects for our audience today.
Thank you. Yeah, well, I should just mention, actually, in the bio it said I was the chair of the Investment Association Financial Crime Committee. I probably was when I submitted it. I've finished my term doing that. I am still a member of the committee. I'm sure some of my colleagues are watching this, just to make sure I'm not over-egging it for myself. So yeah, there are a few different things around asset management and investment management, which I think aren't always obvious, but do make things more complicated. And you're right, the disintermediation is the first one. So there's two key ways that asset managers manage money, either as a segregated mandate. So I have a direct contract with Boots Pension Scheme to manage their investments on their behalf, and they set all the investment rules, and we work together. Or I have a strategy that I want to sell to lots of different people through an investment fund. But when I set up something like a UCITS, an OIC, or an investment those kind of things, there's a whole bunch of rules about what I need to have. So I have an authorised fund manager, I have a transfer agent doing the KYC and the administration, I have an administrator, I have a trustee, and I have the investment manager, which, you know, in our case usually would be us. So lots of different parties doing different things. I'm also then selling globally this product, and I'm going to use a global distributor for doing that. So I've probably got relationships with all of the major banks and maybe local banks in local jurisdictions, and I may have intermediaries beyond that as well. I'm also going to have financial advisors coming to me with clients, and so lots and lots of different layers between us and the client. And the same happens on the investment transaction side. You know, transactions will be brought to us by banks, by brokers, by intermediaries. Is this something that we want to get? We want to invest in. So often it can be a few layers to get through before you get to the individual you're actually contracting with, and where their money has come from and how it gets to you. And I'm sure for everybody on this call, you'll hear that kind of spider web and go, well, that's a breeding ground for ABC risk, for facilitation of tax evasion, and you know, absolutely it can be. And those are the things then that you've really got to get underneath. And it's that complexity of networks of businesses that you're dealing with, of investment product that you have, that can cause some of the difficulty just in transparency and understanding what's underneath things. And that's where you really need your CDD specialists. And I 100% agree with Katarina. You must do this at the onboarding stage. And any of your sales team who say, oh, well, legally it's okay to collect some of this stuff afterwards, but you won't. So let's try and get it now, because no reason for people to answer those questions later on. The other thing is we're trying to make money for clients, so we build financial technology for them. There are lots of different investment products out there, different types of notes and hedge funds, and interesting things. But it's not always obvious where to apply the AML rules. Right? The AML rules in this country are already written around banking. Sometimes you do get useful guidance in places like Singapore. The MAS, the Singapore regulator, tends to write their things around investment management and funds. So there can be some quite interesting stuff to look at there. But you know, when you have a complicated structure with lots of different owners, or an investment structure where the money is moving in an interesting way, who do you pinpoint? Who is your counterparty? Who is the person that you need to go and collect the information of? Can be really complicated. And I think a lot of investment management MLROs will spend as much of their time deciding and making it clear and setting out how you apply AML rules to this particular thing, as they will on intelligence management or criminology and the more threat-focused work.
Steve, thank you for that. Lots to take on board for us as panelists, but also for the audience. And at this point, I'd like to remind the audience that we will be conducting a 10 to 15 minute Q&A at the end of this session. So that'll be in about 15-20 minutes. So please put some questions into the Q&A channel, which you should find on your screen on the right-hand side at the bottom of the panel. We look forward to receiving your questions and being able to address them as well. Moving on now, Andrew, could I ask you, having touched upon risks and threats, I'd like us now to spend some time analysing what is being done by investment managers to mitigate their exposure to financial crime. I know it's hard to generalise, but how would you assess the industry's overall capability and maturity when it comes to financial crime prevention? And are there any examples of best practice that you could share with us?
Yeah, I think one of the points I just wanted to sort of reiterate something that Steve's mentioned a couple of times, and this will sort of go into best practices, and Katarina alluded to this as well, and that is having a holistic view of your customer and the risk associated with your customer, and more broadly across the whole spectrum of financial crime. So Steve's mentioned anti-bribery and corruption a couple of times, and that is so important because people are under so much pressure. And as you mentioned, I'm actually based here in the United States, originally from the UK. The top 5 fines for the Foreign Corrupt Practices Act, so the UK equivalent of the US equivalent of the UK Bribery Act, have all been imposed in the last 5 years, all in excess of $1 billion. So one of the best practices is to have that sort of comprehensive view of risk. And certainly the mantra in the industry, as Katarina sort of already mentioned, is really that need for to do a risk assessment. Where as a securities firm is my risk? Is it on my transactions? Is it on that onboarding phase? And having that, and as an industry, I see there's an evolution to do more appropriate due diligence. And it's really difficult. As you're onboarding, because a lot of firms that were in that business have exited that business. How can they make money on helping you do that appropriate due diligence? But making sure you're using technology so that you've got that consistent onboarding process, and that feeds into a sort of consistent measure of risk as you're onboarding a particular relationship. One of the things that that I've seen quite a lot of is and some of the enforcement actions have certainly been because organizations aren't capturing, don't have a consistent approach across the entire world if they're a global organization to manage risk uniformly. And of course, you need to do that in the context of, I'm guessing Steve and Katarina think they're in a highly competitive business, right? So their organizations, it's difficult to get people to, sign up with your particular organization. The number one reason why a consumer of financial services adopts a particular financial institution is customer experience. Number 2, for the game that we're in, which is super cool, is security and integrity. This is from a recent Javelin report. So we need to make sure that one of the best practices, we do that risk assessment, we do that appropriate capturing of all of the information and onboarding in an efficient way so that we're actually enhancing the customer experience rather than inhibiting it. One of the things that Katarina mentioned is, obviously in that wealth management space, maybe a lot of the folks are a little bit older, they're sort of my generation. And I actually want to make sure that I'm working with an organization that has integrity. So I sort of don't mind providing that sort of extra piece of information. So I think best practices include that uniform and consistent onboarding process. So if I acquire a new product, I don't get asked the same questions that I've been asked before. Then I really like something that, again, my fellow panelists have sort of mentioned. The idea of, once you've adopted that risk-based approach based on your particular organization's tolerance for risk, is you also collaborate. And I always talk about 3 pillars of collaboration in this particular industry. There's collaboration you have internally, so that that your entire team is educated, your entire team is able to identify red flags for potential money laundering. So there's that collaboration. Second tier is, or pillar is, collaboration between financial institutions, right? The making sure that we understand the type of attack vectors we're seeing, the type of typologies that we're seeing around laundering of money through the financial system. And then the third one, and I think we're getting to a point where this is actually more widely accepted by the FCA and FinCEN and FinTrack in Canada, the Monetary Authority in Singapore, is collaborating with the regulators and sharing information. In the US, where there's a as part of the AML Act of 2020, there's a whole introduction of this sort of whistleblower provisions. You know, if someone identifies potential money laundering, let's inform the regulators about that, but let's make that a feedback loop. So I think those are best practices. Uniform customer onboarding, the processes, doing a risk assessment, making sure you're adopting a risk-based approach to your financial crime risk, and then collaborating across the industry.
Thank you, Andrew. That's incredibly insightful, and hopefully will be helpful to the audience as well. Katarina, one thing that we at Themis always find key to any successful risk management strategy is securing strong buy-in from senior management. You've talked to us previously about the importance of setting a clear anti-financial crime tone at the top, including through an awareness of personal responsibilities and liabilities. Do you have the sense that senior manager responsibilities in this sphere are sufficiently understood within the investment management industry?
Yeah, thank you. I think when I read that question in advance, it made me think, well, what does it look like? Really good buy-in, really good tone from the top. And I think that's where to start. And I would probably say that I think most organizations will probably take a few of it and then maybe need to work on some of the others. For me, the really good tone from the top, the really strong buy-in when you feel that there's ownership of the risk and the policies you've implemented to mitigate that risk all the way up. So when we, when there is challenge around, oh, why can't I do this? Or why can't I onboard this client? It shouldn't be me saying, oh, because of these risks. That should come straight from the business side, straight from the top. We don't want that kind of client, if that is what you decide. And I think the other part of a really good buy-in from the top is when you can properly discuss and agree what your risk appetite is. Because it's very, very easy to say we have a low risk appetite, for example, for financial crime, or you can make it really hard for yourself and you can say we have zero tolerance, which kind of doesn't really work. But if that's just something that you say, then it's not really going to happen. You're still going to have, parts of the business wanted to onboard very high risk business. So I think it's really important to have that understood at the top. But here I think it's a two-way street. I can't just sit as an MLRO and say, oh, the tone from the top is really not there. I have to feed them, what they need to know and actually tell them about the risks, because at the very top level, at board level, they have so many risks to worry about, and AML and financial crime is just part of it. So I see it very much as my job to really prepare the material for them, to make them see where the problems are and where I need help. I can even say, I really need your help on this one. Could you help me reinforce the message? Could the message come from you rather than me, for example? So I think it's all about having that contact with the top. And most places, I would say, probably have that initial tone from the top. It's that true buy-in, that real understanding of what it means to have a low risk appetite, for example, that may need to filter in. But I also think that with SMCR coming in, that has probably heightened a bit the understanding and the seriousness around this. But I would also say that MLROs have kind of always operated under an SMCR scheme in a way, because we've always had to justify the controls and how we got to the conclusion that the controls were appropriate through the MLRO report. So it's not something that is, it's not new to us, even if we're in wealth management, basically. So I think any organization probably needs to work on it more or less, would be my answer. Have I noticed a significant difference to the bank? Probably not. And I think as well, I tend to tell my board as well, look at the fines. The fines are still on the banks, but that may very well change. But look at what the recent fines have shown. They've shown that risks have been escalated into board in a lot of these big banks, but nothing was done about it. That's your risk, that's where you need to look for things. My risk is if I've misjudged the situation completely and I've implemented controls that simply don't stop financial crime. So it's a lot about the relationship and good buy-in, I would say.
Thank you. It does sound as if there's got to be a two-way street between yourself as the MLRO and the board back to you, but also from the top to the rest of the organization, particularly the client-facing part of the business, to understand what is acceptable risk and what is not acceptable risk. And as you say,
and I think, sorry, Carol. One thing that I use in all this is reputational risk, because I think that's so much greater in the investment management space than it is for banks. The banks kind of seem to, get away with it, because if you have a current account, you're maybe not worried about your £8,000. But if you have an investment account, you would probably move that money if we ended up in the top news for the wrong thing.
Yep, definitely. And you want to make sure that your funds are protected. So having good controls around the business against financial crime is key for the reputation of the investment manager. Yeah. We're racing ahead here with our time. But Steve, before I pass on to the audience with their questions, one last one for you. We've already discussed certain regulatory aspects, but I wanted to focus on these a little bit more now. From your perspective as a Global Director of Financial Crime at Aviva Investors, do you think regulators are communicating their expectations with regard to financial crime compliance in the investment management industry in a clear and comprehensive way? How does this vary internationally?
Thanks, Carol. Who wants to say no to a question like that? A regulator might be listening. There are changes. We've seen the FCA come out and do a couple of speeches recently about really applying a risk-based approach and not being tied to the controls, the traditional controls that we've all had in place before. I still think there's probably a bit of discomfort around that. There's three areas on regulation that are a concern for me at the moment, and I can summarise them quickly as Brexit, sanctions, and tech. On the Brexit side, we have the divergence. It's happened. We've got two issues there for global asset managers. For those areas for those businesses who have still got in Europe, they've got to meet European rules. European rules are moving at a different speed and different direction to the UK rules. We've previously managed that centrally from London, but does that make sense anymore? Do we actually need more focus and regulatory development within our European businesses? And then in the UK side, we will get new rules. Right? We've got a kind of a holding position at the moment, but I think the UK government are quite interested in doing and in seeing what they can do. And like all of these things, there's some opportunity there to streamline things, to provide more clarity. There's also an opportunity to create a whole lot of cost and work that doesn't make a lot of difference in the long term. So a lot to work with as we carry on. On the technology side, people might not be so aware of this, but the number of rules that have come out about cyber, operational resilience, business continuity across all of the jurisdictions has just increased at a huge rate. It's not something that most firms are brilliantly set up for, because you can have tech people or compliance people, and they don't tend to be in the same room talking and don't always understand what things are being asked for. I really would recommend that people just look out for that, because there's always been a tendency for the tech side of the world to look at the rules and go, yeah, we've generally got that, not to have a compliance focus, line by line gap analysis and what. And then on sanctions, a lot of us will have been hit by the US-China sanctions at the end of last year, and the positions that have come out of the UK, and this of course could happen in Europe, which are difficult to manage in a global business. And you end up having to ring fence things to only invest certain funds in certain jurisdictions, and operationally and legally. How is it? Can you make that work in a way that you can trust and doesn't breach the regulations?
Well, that is definitely a great deal to have to manage, especially, you know, as you say, the tech side and the compliance side working together to develop technology that works and covers all the different requirements from the different regulators. And that is a great segue to Andrew, because he deals a lot with technology in this area. And as we've been hearing, that regulators are increasingly emphasizing the value of automated solutions in financial crime risk management. Could you tell us, Andrew, a bit more about some of the most relevant applications of anti-financial crime technology in the investment management industries, more specifically?
Yeah, absolutely, and I do, and maybe it's a bit easier for me than Steve or Katarina to comment on the sort of from a regulatory on the regulators and their perspective. I just in answer to the last question, I'd go back to the numbers, right? So the amount of money that's laundered through the global financial system, 2 to 5% of global GDP. When I got into this game doing OFAC screening for the Federal Reserve 30 years ago, that was the same number. The regulators are realizing that they need to collaborate, and we need to use technology across the industry to actually materially impact and reduce the amount of financial crime that goes on. So I think we're seeing a sea change with the FCA's advocacy around the use of different technology. The same with the Monetary Authority in Singapore, the Hong Kong Monetary Authority, FinCEN here. They're all talking about how we can be more effective in managing financial crime risks. So that, you know, as you mentioned right from the start, these are not victimless crimes. I mentioned in the preparation, you know, the FATF say their opening plenary, they had this tagline: "Stop money laundering, save lives." That's what the people on this webinar are doing. What we try and do in the provision of technology is really split it into 3 sort of areas. Detection, which is that sort of front end piece. You know, am I detecting that this relationship exceeds a certain tolerance for risk for my organization? Then, of course, once you've done that sort of initial due diligence and detection and risk scoring, you want to do the monitoring of different activity. You want to do frequent refreshes of your due diligence around your customers. In the United States, it's a Dun & Bradstreet statistic. There's 184 changes of ownership or control of organizations every hour of every day of the year. So you need technology that is going to basically refresh. It's going to do regular checks against adverse media lists, for example. Detection, and then of course you need to empower your team with the information to make a decision. That's that remediation stage, alert and case management. And then of course reporting. So they're the 3 sort of pillars to the sort of technology solutions here. But you need to overlay, you need to empower the teams. So automation is a big thing that we talk about right now. So if I'm doing due diligence, I don't want my people that are evaluating risk and looking at a relationship to have to go to 37 different systems and collect information. So we've been overlaying different types of automation to capture all of the necessary information. So I'm empowering my investigators, my analysts with all of the information, so streamlining the operation. And then of course, everything that we talk about is the use of more advanced analytics. So for identifying different types of red flags, how can we identify those using technology, using machine learning techniques? And of course, it's interesting in this particular industry because we don't have the volume of data that we would have in a bank, for example. So how do we do that? And there are different techniques that we've been applying and looking at not only individual behaviors, but looking at expected behaviors, and then behaviors across peer groups or clusters of particular customers. So they're the types of technologies that we've been seeing providing to financial institutions, but also seeing sort of evolve very rapidly in the last couple of years.
Thank you, Andrew. And the technology, as you said, needs to continue to evolve because the criminals are always one step ahead. And the same thing goes with the regulations. They need to evolve. They need to keep up with all the different things that the regulators are doing. Recognizing where we are with time, I'd like to wrap up this session between the 4 of us and pass on to Q&A. There have been a lot of questions that have come in, but Katarina, if I can pass one on to you, this is from Gabriella Griffiths. Could you please elaborate on good KYC practices for complex organizational structures, companies within companies within companies, and complex beneficial ownership structures? Is there a certain type of structure you would consider too risky? Where do you draw the line?
Oh, I was hoping I was going to get that question. I think, again, drawing the line, that's down to appetite. You can almost onboard anything if you have the appetite for it, meaning you take the risk that there could be something in there 10 years, 5 years down the line that you need to deal with. I think there are some structures where you really do wonder, why do they need that layering? And it is obvious that it is for tax reasons. Could you even determine whether that's tax evasion or tax avoidance? Probably not. So I think my appetite probably goes somewhere around there for some of those structures, or there has to be a really good rationale backing it up. And I appreciate some of these structures were set up maybe in the 80s when it was quite popular to do so as well. But also with these structures, be careful, because I've seen a few where, for example, you set up a nice little investment offshore company that you own wholly yourself, simple structure, nice and easy, 100% owned. But where is the money coming from? It's from that whole little empire of business out in some, quite high risk part of the world that feeds in. And it's also the source of wealth is business generated. Well, that's not enough, is it? So, there is so many aspects of these, particularly the offshore structures, where you need to not just understand the ownership structure, but why is it set up like that? And even if the ownership structure is clear, where is the money coming from? So there is a lot to trip you up. We're quite careful with those kind of structures, and probably have a lower risk appetite than some others. But again, sorry, it does come down to appetite and what you are prepared to risk in terms of reputation again.
Yeah. No, it's interesting that you say that, because it comes back to a point you made earlier about onboarding right at the beginning. It's knowing the source of wealth of your customer, knowing them fully. Where are they operating? What are the structures that they've put in place, and why have they done all of that? So
and don't be afraid to ask. I mean, I see this a lot, right? It's embarrassing, but yeah, just be proud. You do it for good reason. And if they don't like it, you probably don't want them. So yeah, never apologize.
Very good point. Never apologize. Here's another one from our audience. Steve, this one for you. It's from an anonymous attendee. You mentioned bribery and corruption risk, particularly with third parties. What kind of controls would you like to see? Do you find that COVID has increased the risk from bribery and corruption? And with the inability to travel and carry out face-to-face due diligence, what can be done to mitigate these risks remotely?
A few things in there. I mean, firstly, is the requirement to have controls over associated parties. So that you're responsible for your bribery and corruption risk management framework internally, but also with those people who are doing business, who are selling business on your behalf and operating out there in your name, which is not always easy. So how do you do that? It's normally contractual. If you're able to have audit rights and ways of going to check how those things work, that would be very helpful. You can end up in some protracted discussions when the contract comes, and you tend to go round in a cycle which says, well, just say that they have to meet the requirements of so and so law, and they go, well, and then or set out the actual requirements you need and don't mention the law in particular, and you tend to start with one and then they always want the other, but at least you've got a few different options. The important thing is to really be clear about what your distribution strategy is, where people are, do they have the right information? Are you, if they're in riskier places, are you doing extra stuff? And what's the gateway? So you can have whatever people you like promoting your product, but they can't actually invest in it until it comes through. So it is that way you make sure you've gone through everything 100%. Has bribery corruption risk increased in COVID? I couldn't say that it definitely has. We've continued to make sales, which is good news. I think we're really worried about that, but those things still have happened. I would say all financial crime risk increase where it's all paperwork and not so many people, because it's just that much more difficult to know that you're definitely dealing with the person that you thought you were dealing with. And the due diligence piece, 100%. The things that we normally do to go into firms, associated persons, transfer agents, to do that work, we're having to do online now. They don't want to share documents. I can understand that. I've been in exactly the same position. You end up with people putting stuff up on the screen and trying to read it like this. It's not very clever. I think when we get back to going to do face-to-face due diligence, it's going to be a bit of a surprise. And I think most of us will be saving up questions for when we can go and look at people in the whites of the eyes and see and go through documentation in detail.
Yeah. And you mentioned risk and risky jurisdictions. And Katarina mentioned risk appetite, and it's knowing also upfront what are the risks that you're dealing with when going to certain high-risk jurisdictions. To what extent are you willing to accept individuals as customers from those high-risk jurisdictions? Andrew, here's one for you. And it's from someone called Mohammed Yassin. Prevention of cybercrime is important, but once the fraud or cybercrime takes place, do you think there is enough regulation to protect the victim, especially if the crime redirects money to fraud accounts from international clients?
No, I don't think there's enough protection on those victims of cybercrime and financial crime in general. I think one of the things that we've talked about throughout this is that we talked about vulnerable populations. Well, I think we're probably all vulnerable. Something that Steve just mentioned there, has internal fraud or bribery and corruption increased? Well, we talked about this. The financial crime generally is counter-cyclical. People are under more pressure. So it's very likely that there's, and some of the enforcement actions here in the United States in the last couple of years have been about sort of internal manipulation, market abuse, product suitability issues, sales malpractices. So I don't think there's enough legislation. There is legislation evolving to protect the victims of financial crime. I live in New York State, and obviously we have the local legislation under the local legislation here to protect people and to mandate that we need to put protections in place as financial institutions to protect them from cyber attacks. So I think that it is evolving, but there's probably not sufficient legislation in place right now.
Thank you. Being a victim of crime is always in an unfortunate situation to be in, and not having the protection of the law, it makes it even worse, because you think that the law will protect you, and as well as the law enforcement agencies. But as we mentioned earlier, the criminals are always one step ahead, and the regulation and law just isn't there necessary to protect those that need that protection. Very conscious of time, and I just want to say thank you very much to everyone that has joined us. It's been a really interesting conversation that we've had. Andrew, Katarina, and Steve, can't thank you enough about all your viewpoints and everything that you've said. It's been a really interesting panel. I take away a number of things myself. One is, from being a MLRO or a senior compliance officer, don't be afraid to say no, inform up the chain, be very proactive. It's really key to do that. Look for alternative solutions, particularly around technology. Don't be afraid to investigate further in terms of source of wealth, the background to an individual, because at the end of the day, when they're part of your system, it really becomes difficult to untangle all the transactions that they have undertaken. And last but not least, especially in the investment management industry, reputation risk is critical. And if you get fined, it is a massive impact on cash flow and share price, profits, and valuation for a business. So it's really key to take financial crime risk as part of your operational risk framework. So just before I wrap up and say a big thank you also to our partners, Fiserv, for your support in shaping our joint research and in broadcasting this webinar. It's always a pleasure to work with you, and we look forward to many more Themis Fiserv initiatives in the future. And finally, everyone that joined this webinar, thank you so much for listening. Should you wish to gain greater insight into the financial crime risk in the investment management industry, or when dealing with counterparties from high-risk jurisdiction countries, please download our reports on the CMIS Insight page. And I wish you all a wonderful afternoon.